So we are starting our revision class, and I take this opportunity to welcome you to our last bit of preparations for our exams. We will be able to do the whole of 2024 past paper. And in this past paper, I just want to focus on the areas of the computation. There is a document which I had already shared in our WhatsApp group, which is having, for example, these areas of the theories which the examiner is asking here. And if you can be able, or if you are keen enough, you'll be able to realize that most of these theories which are being tested, they are coming from those notes which I've already provided. So just be very keen with the questions, with the notes, and never forget to check on the Islamic finance, So I wanted to look on question number 1, right? We are being told the following information will be able to relate to potential investments, namely investment M and investment K. Investment M, that is our question number 1, 3. So investment M may already be given probabilities and the return. Then we have investment K given also probabilities and return. What I can be able to see there is that if you look on our today's slide, there are areas that we like to do our investments. And areas which, for example, Eric wants is not what Judy will be able to do that investment. So the aspect of the investment, we normally want to check on what will be the return of the investment. How much is it going to be achieved in terms of the return of the investment that you are going to be making? So that is one of the critical things in which you have to be checking. What will be the return of that investment I want to make? Now, the questions of returns, we are talking about expected return, right? My audio is not clear. Is it the case to everyone? Mtu wako amenionea because I normally talk with a very loud voice. Unless now everyone is experiencing the same. Is everyone experiencing like me now? Is my voice not clear? So sijui Judy amejibu nini. I don't know umejibu nini. Let me know whether the voice is clear. Okay. I think the audio is very clear. And all students can be able to just take from an end in what might be the cause. So we have been told the following information relates to two potential investments, M and K. So we have been given the probabilities and returns there. And then we have been required to compute the expected return of each for each investment. Number 2, to determine the standard deviation of M and K. Then number 3, we have been told to compute the portfolio return, assuming that 30% of the investment is the total wealth, sorry, is invested somewhere, is invested in M, and 70 is invested in K. So they have already given you the proportions there. So the first thing is to look at this question is, how do we normally compute the expected return? Crucial, very crucial. So we can be able to check on that. The person is great. The voice is not clear, Judy. Okay. Ani sauti sasa imeharibikia wapi? My voice personally haijaikuwa mzuri since the time I had some issues even last week. So inaweza kuwa na scratches kidogo. I know that is what you are responding. But let me, even if it gets worse, let me know. Okay. Number one, we are being told to compute the expected return, the expected return. They compute the expected return for each investment. The examiner wants you to compute the expected return for each investment. Senior. Now, to get the expected return of each investment, for example, let me look at the expected return of M. Okay, so I'm going to be taking, this will be the summation of our return times probabilities. The summation of return, and then we multiply by the probability. So in this case, how much is the return is provided for investment M? We have been given 20 times 0.30, plus the next one will be 8 times 0.40, plus the last one, which is -4 times 0.30, right? And I'll get the expected return of K. The expected return of K, we do the same. And you can see the returns are 20 times 0.20. Plus the other one is 8 times 80 multiplied by 0.6. Then we add, the last one is -4 times 0.20. 0.20, right? 0.20. That is what we are computing the expected return for each investment. So we have 20 times 0.3 plus 8 times 0.4 minus 4 times 0.3. Here we are getting 8%. Then the other will be 20 times 0.20 plus 8, we multiply by 0.6, minus 4, we multiply by 0.2, getting 8%. Getting 8%. 8%. Are we doing the same? 28. So for each investment, okay. That is what the example wanted. So that is the answer for both. Number two, they're asking me a very simple question there. Can you be able to give the standard deviation? The standard deviation of each investment. Very simple here. To calculate our standard deviation here, we normally take the root of what? The summation of our return minus the expected return multiplied by probability squared there. Right? Multiplied by probability. Now, let us start with the investment M. Let us start with investment M. So in this investment, you are going to be taking our return. For example, it will be 20, right? 20 is the return, minus 8, which is the expected return, squared, multiplied by the probability of 0.30. The other one will be 8, which is the return, 8, minus 8, which is the expected return, squared, we multiply by the probability of 0.4. The last one will be -4, minus 8, squared, multiplied by the probability of how much? 0.30. So what is your answer here? How much is your answer? Very simple. So we start with the first one, 20 minus 8 squared. We multiply by 0.3, getting 43.2. The other one, I think this is 0. Not even I think that is true. Then the other one will be 4, -4 squared is 16, times 0.3, getting 4.8. Getting 4.8. So 43, here we are getting 48. So what is the root of 48? Get the standard. What is the root of 48? So the root of my answer should be 6.93. This is the standard deviation with the examiner is asking. 6.93. 6.93 is the standard deviation in which the examiner is looking for. No, no, no. -2, -8 should be 12. This should be 43.2. Sorry for that. So this should be around 86.4. 86.4. 86.4. So how much it is? So the root of 86.4 gets 9.30. 9.30. 9.30. Now let us look for the other investment. Investment K. Investment K. Now for investment K, you do the same. It will be 20. I think it will be the same, but because the examiner is asking, we can just be able to repeat. It will be looking like this. I think the returns are the same. Okay. Now it will be 8. 8 minus 8 squared multiplied by 0.60. Then the last one will be -4, -8, 12 squared multiplied by 0.20. So let me do the first one, 12 squared and multiplied by 0.20. Getting 28.8. This will be 0 and this is 28.8. Okay. So how much? That is 2. We're getting 57.6. The standard deviation should be the root of 57.6. Getting how much? 7.6. 7.60. 7.60. That is what is required there. That is what is being required. That is the requirement. That is the requirement. That is the number 2. Number 3, I can see the examiner is asking us to compute the portfolio return. And number 3, it is normally done like this. To get the expected return of the portfolio, right? The expected return of the portfolio, the expected return of the portfolio, we are going to be taking the expected return of M. We need to by the weight of M plus the expected return of K times weight of K times weight of K times weight of K times the weight of K. Okay, looks like that. So the expected return of M. What is the expected return of M? It is 8. We multiply by the weight, which are already provided in note number 3. The weight, for example, for M is 0.3. Plus the expected return of the alarm is 8 times 0.7 times 0.7. And whatever you're going to be getting here, it is a very simple thing. We should be 8%. We should be 8%. That is the requirement. That is what you are supposed to do when you are doing that question. That is the requirement of that question. That is what is needed there. That is what was needed. That is what was needed. Any person with a question, please? Any question being arise which can be raised, sorry, from this question now. Tuko na swali. Do we have a question, please? Eric? Eric, do we have a question, please? You can see if you have done the question in that manner I have done, already you have 8 marks. You are yet even to approach a theory question. But a secret, by the way, which I know I have never told you. A secret when you are doing an exam. The first thing that you're supposed to be doing, you need to pass through all the questions first before you write anything on that booklet. Just go through all the questions. Once you finish going through the questions, I would like you to start the questions with the best question which you can score around 15. 10 and above. Let me talk about 10 and above. Do you know what the examiners normally do? Nasikianga mtu akisema, and how that exam was easy. How nilikuwa nimeiba, right? These examiners, wakipata, for example, umepata 2/20 in your first question, they never mark that again. They don't focus on doing that. Because they are rushing, wanakimbizana. You know that is a game of numbers. They are rushing to mark as many papers as they can. So to make it interesting, to make them mark your past paper or to mark your booklet, sorry, it is very important for you to start with the best past paper, the best question, the best question. This is the only secret by your passing exams. Number two, never leave any theory unanswered. Never ever. Never. Any theory, na iko kwa mahesabu, whether you are doing a FAR, you are doing a FEM, you are doing a ME, you are doing taxation, right? Always make sure the theory you have done everything. There is another secret which number 3. I cannot say it here public. Tutaongea pale kwa WhatsApp group. Hiyo tutaongea huko. Hiyo tutaongea huko. Wanaweza tusikiza, right? Tuachie hapo. Wanaweza tusikiza hawa watu. They are following us on the YouTube also. So we don't have to expose the secrets which are supposed to be winning. That is our game plan. We shall be able to plan it on the other hand. So question number 2B, Julie, you can read, please. Question number 2B, Julie.
Sophia Wampia intends to invest shillings 2 million in a 12% debenture for 3 years. The current market value of the debenture is shillings 80 per debenture. The required rate of return on the debenture is 10% and the par value is shillings 100 required. And advise the investor on whether or not to invest in debenture for marks.
Very good, very good. Thank you so much. Can you be able to do the valuation of bonds? That is the valuation of bonds, right? We have been told that Sophia is intending to invest 2 million for only 3 years, right? That you can see it is a redeemable bond. So the current market value of the debenture is 80 shillings per debenture, right? 80 shillings per debenture. So the required rate of return on the debenture is 10%, and the par value we have been given as 100. Thank you so much. So what am I supposed to be doing? This question now is there next semester or in our exam now. This question is coming. And this is the situation right now. This is the situation. Now, I just want to take you back to where we are coming from. Where we are coming from. I will be able uh, um, to inform you that the videos that you have, they will take you places that you have never seen before. Now, I remember when we were doing the valuation of bonds, we have a redeemable and we have redeemable so convertible. By the way, what I will be able to do, I will share all the videos in a good arranged manner. Now, how are we going to be getting very simple things here? Very simple things here. Let me see how. Very simple, very simple. Thank you so much. Now, because we are being told, advise the investor whether or not, right, to invest, whether or not to invest, I will be able to know what is the value of the bonds. What is the value of the bond, right? So let me talk about the market value, which will normally take your interest. And you know, if I have invested in any interest, right, you are going to be getting, if I have invested in any bond, sorry, I'm going to be getting interest throughout the period in which I have invested. Now, in this case, it means your interest is specific. Present value is a factor, and is it R%? Are we dealing with R% now? KD, 10 years, plus, right? We talk about the redemption value. Let me talk about the redemption value. We multiply by P5, KD, 10 years, KD, 10 years, right? It is. These are the ones you're going to be redeeming at the end of year 3. So the formula for this, and I want people when they are using their formulas, is 1 plus R related for negative n, right? This one will be 1 minus 1 plus R related for negative n divided by R. That is the formula for P50. The reason I try and don't like people to, I don't encourage you, by the way, to be using the table at the back of your paper. It is these problems you can be able to see here. What if the KD is, which is given, is not part of the table? Now, in this case, when we are calculating the interest, right? We are taking the interest for the debenture. We have been told it is 12%, right? The debenture is how much? The interest we have been, the required rate of return of the debenture is 10. So we are going to be taking 12. We multiply by the par value, which is 100. That's it. That one we are going to be getting our interest. Then we multiply this by, if we far, right? The cost of debt is the required rate of return given as 10. The number of years of our investment is 3 years. Plus the redemption, we normally redeem at par value, which is 100. We multiply by 50, right? KD. KD is 10%, 3 years. Very simple, right? I know this one is 12. We multiply by this 12, we multiply by what? Judy, 12 we multiply by what? We multiply by what? Someone here? To avoid this confusing you, let me write in the value of the bonds. The value of bonds. Ah, we multiply by what? Someone, please. Clarice, how are you? It's long since we saw you. Clarice, what are you multiplying here with?
Yes, I can hear.
How much, what is the figure are we getting out of this? What is our different factor there? Kama mjui kutumia hii, you might be in a crisis now. Nina, how much is it?
It's 2.4868.
2.4?
868.
868. Thank you so much. How have you come up with 2.4868?
I've taken 1 minus into brackets 1 plus 0.1. Close the brackets, raised to power -3, all divided by 0.1.
Thank you so much. Thank you so much. He has applied this theory, this formula here. That is what he has applied to get 2.4868. What about on this side? When I multiply by 100, now we apply this formula for the lump sum. This is an annuity formula, right? This is lump sum. Vitu zingine kama hizi, we should not be wasting a lot of time here. So this one will be 1.1. 1.1, we raise it to power -3. I'm getting something closer to this. 0.7513, 0.7513. That is what we are getting. So how much is our total here? It will be 12 times 2.4868 plus 1,100, sorry, we multiply by 0.7513, getting around Kenya shillings, 104.97. 104.97. That is the value of the bond. But when you look at the question, we're being told the current market value of the debenture is 80. 80 per debenture. Then the examiner anakuuliza pale chini requirements, right? And whether the investor, right? Whether the investor or not, whether the investor to invest or not on the debentures, we can be able to advise it. Say, we can be able to say the intrinsic value, the intrinsic value, the intrinsic value of 104.97 is greater. This one is greater than the current market value, of current market value of Kenya is 80, right? Hence, they should do what? They should invest because the value given it is less. The value given, the market value is less than the true value of those securities, Maybe I have format. I have format for doing that. I have format for just doing it. 4. That is how you pass FM. Very simple. It is very simple. We have question 2C. By the way, you have the possibility of supporting Mwalimu Pale on the comment section of our YouTube. You say that Mwalimu is good, Mwalimu ni mbaya. That is the feedback you can make us grow, right? That is the feedback you can make us grow. Right. So just be active there. We have a lot of videos, by the way, which we did since we started our online classes. That is in 2020. We are just unatembea huko ukitafuta some videos for a certain topic. They are there. We have done a lot of questions for these units. Someone to read for us question number 2C. I think we are in question 2C, please. Someone? Someone is reading.
Mandrax Limited is an e-business company that trades solely over the internet. In the year 2023, the company made sales worth shillings 15 million. All sales were on 30 days credit to commercial customers. Extracts from the company's most recent statement of financial position relating to working capital are as follows. Trade receivables, trade payables, bank overdraft. Additional information. In order to encourage customers to pay on time, Mandrax Limited proposes introducing an early settlement discount of 1% for payment within 30 days, while increasing in normal credit period to 45 days. It is expected that on average, 50% of customers will take the discount and pay within 30 days. 30% of customer will pay within 45 days, and 20% of customer will not change their current paying behavior and will pay within 60 days. Mandrax Limited currently orders 15,000 units per month of product P, demand for which is constant. There is only one supplier of product P. The cost of product P purchases over the last year was shillings 540,000. The supplier has offered a 2% discount for orders of product P of 30,000 units or more. Each order costs Mwalimu, scroll down the question.
Okay.
Each order costs Mantrax Limited shillings 150 to place, and the holding cost is shillings 0.24 per unit per year. Mantrax Limited has an overdraft bank facility charging interest at the rate of 6% per annum. Assume 365 days year required. Calculate the net benefit or cost of the proposed changes in trade receivable policy and comment on your findings. 2. Using suitable computation, determine whether the bulk purchase discount offered by the supplier is financially acceptable.
Thank
Comment
you so
on the
much.
assumptions.
Sorry?
Comment on
It's
the
acceptable, and then we are
assumption
going to be
made.
commenting on the assumption made in your computation. Sorry for interfering. This question you can just be able to interpret using a common sense, by the way. We can use a common sense to analyze the question. But also, it is good to follow up on the areas. These are the things, by the way. Most of our credit controllers within the organization will have a look at when it is a period to determine how and when should I be advancing credit to our customers. Those things normally comes with those things are always available to our things called just looking on it here, the cash operating cycles, which we talked or which you'll be able to see in the videos which I'll be able to share for you. The cash operating cycle is just also known as the working cycle, operating cycle, cash conversion, or manufacturing cycle, and it is referred to the duration taken by the firm from the time it is first cash through the purchase up to the time it is going to be recovering the same cash from each customer through the sales. So the cash operating cycle, we normally have two. We normally have the cash operating cycle for the normal trading firm, and also the other one is always for the manufacturing firm. That is the basis of it. The formulas that I'm going to be using here, they are not new formulas. They're just a formula which you'll be able to come across them when you are dealing with the ratios. When you're dealing with the ratios, but let me just first on check on the question. Let us check on the question. So we are being told here, number one of the question, to calculate the net profit or the net benefit or cost of the proposed changes in the receivable policy, right? In the receivable policy, and we are going to be commenting on our filings. When you look on the question, some students might be wondering, where am I going to be starting this question? And what I can be able to say, when this question is starting in that manner, it is very important for us to start by, let us compute the receivables period. Receivables, right? The receivables period, we normally take 365. We multiply by the average, receivables. Then we are going to be divided by the annual credit, the annual credit sales, right? Remember, in most cases, an examiner might be silent, and we just assume those sales are all in credit. When, if it is not specified, don't stress yourself. If it is silent, always also treat it in a silent mode. Now, in this case, when I go back to the um, question, right? When I go back to the question, we need to be evaluating the net benefit of cost of the proposed. So let us calculate the standard receivables in days. The sales of hours we are being given as 15 million from the beginning of the question. We are having the average receivable, which are basically called the trade receivables in our question. We are already being given there. So to get my question is very simple. I just need to take 365. We multiply by the trade receivables given as 2466. 2466,000. Then we are going to be divided by the annual credit sales, 15 million. 15 million. So how many days? How many days? How is the receivables period? These are debtors. These are debtors period, right? So 355 times the receivable period, it means the period you can be able to supply goods to the customers without getting a pay. How many? How many days? 365 times 24, 66,000. Then we divide by 15 million. Getting 60 days. Those are 60 days. 60 days. That is how we normally get receivables periods, right? That is how you get the receivables periods. Number two, and this is the current, by the way. The current receivables periods, the current of ours is that one, right? But we have our proposed. Let me look on the proposed. Allow me to call it proposed. The receivables period for the proposed, right? So they are giving you some in note number 2 there. They are saying it is expected that on average, 50% of the customers will take the discount and pay within 30 days. Right? So 0.5, we multiply by with the days. 0.5 will be paid within 30 days. You continue with the same statement. This is the simplest way of getting that. We are being told 30% of the customers will pay within 45. 0.3 times 45, right? 30% of the customers will pay within 45. Kumbe Judy was not here. Then we are being told 20% of the customers will not change the current pay behavior and will pay within 60 days, right? We are being told 0.2 will be able to pay within the current, which is 60 days. So how much it is? How much is for the proposed? How many is the receivable period as per the proposed additional information number 2? How much it is? So you just need to say 0.5 times 30 plus 0.3 times 45 plus 0.2 times 60. Getting around 40 days. Allow me to use the whole numbers. You're supposed to be having us a day or to deduct us a day. So let us put the whole numbers there. That is the criteria of getting the proposed. Then from there, because we just need to know, is the organization benefiting or is it going to be having some cost to the current proposals in which we are going to be making, right? Now from there, From there, let me look on something here. I hope the voice is now clear. So after you get the receivables period, it is very important for us to calculate the current receivables investment. How much is the current receivables investment? The current receivables investment. How are we going to be getting the current receivables investment? I remember our sales, we are getting there 15 million under the current receivables, right? 15 million, the current receivables. Let me see. The receivable period we have this. So in simple terms, let me just use simple things here. Let me use simple things. Let me see how we can be able to interpret it for better understanding for you. Now, when you look on the average receivables, so that we can be able to check on whether there is any reduction or increments. The average receivables, we talked about 2466,000. Okay. Then can we be able to get the proposed trade receivables? The trade receivables. Now, can we be able to get this one from the proposed policy, right? In this case, remember we have the receivable period. We have gotten 40 times the number of days, 40 is equal to the number of days, which is 365, times, let me talk about the average receivables. Then we divide this by the number of what? The number of days, the number of sales, the annual credit sales. So to get the proposed trade receivables, I'm going to be saying it is 40 times 15 million. We divide it by 365. This is getting your average receivables. Your average receivables. How much is your average receivables here? The average receivables will be how much? Under the proposed policy. So 40 million or 40 shillings times 150 or 15 million, we divide it by 365. Right? We are getting how much are we getting there? We are getting something closer to 1643. 836. 1,643,836. Now from there, can we be able to see whether there is a reduction in receivables? We say yes. There is a reduction in receivables. By how much? How much is the reduction in the receivables after the proposed? We say when we take 2466,000, we minus 1643,836. So how much is the reduction? So 24,600 minus my answer, getting around Kenya shilling 822,164. If the new proposed, right? If the proposed is going to be implemented, there will be a reduction in receivables by that amount, right? Now, I also want us to calculate something there. What will be how can we be able to calculate the costs of early settlement discounts? Assuming that there are people who are getting a 50%, 15%, 50% of the customers are going to be getting a discount for early settlement. I think as per that information provided there, we are being told somewhere. Where? We are being told in note number 1, in order to encourage the customers pay on time, right? Pay on time. Madras Limited proposes introducing an early settlement. There is an early settlement discount of 1% or for payment within 30 days, while increasing its normal credit period to 45. Can we be able to, because that discount you are giving, it is a cost to the organization. It is a cost to you. So we talk about the cost for early settlement. The cost for the early settlement. How are we going to be getting the cost for the early settlement? The cost for the early settlement, right? We are going to be taking our sales. Our sales are 15 million. Times, this will be 50% of the customers, right? 1% discount. 1% discount. How much is that? How much is that? 15 million multiplied by 0.5 times 0.01. We are getting a cost because we are getting a discount. These are money that you're not going to be getting back. This will be your cost of 75,000. I'm just breaking it down like that. I'll just be able to combine it later. So that is the cost for the early settlement. The company will be losing 75,000, but it will be encouraging them to be doing those, to be doing all that settlements earlier. Then we need to be calculating something there. Can we be able to calculate the interest savings from reduced receivables, right? The interest savings from reduced receivables. We have been told note number Madras Limited has an overdraft bank facility charging interest of 6% per year. In simple way, we say, can we be able to calculate the interest savings? The interest savings from reduced receivables. You know that is why reduced receivables. So how much it is? How much it is? The interest savings from reduced receivables, right? It means to get your interest savings. To get your interest savings, you're going to be taking the reduction in receivables, you're going to be having a reduction in receivables, then we multiply by our interest rate. Multiply by the interest rates. So the reduction in receivables, we got how much? The reduction in receivables, ours was 822, 164, we multiply by 0.06, which is the interest now. The interest, which is keeping some overdraft somewhere. So 822, remember when there is a reduction in receivables, we are not happy. So 822, 164, we multiply by 0.06, getting around 49,330. 49,330, right? 49,330. To make your decision, can you be able to calculate our net profit to a cost? Can you be able to get that? How are we going to be getting our net profit? Our net profit is normally, you normally get it by taking the interest savings. You normally get it by taking the interest savings with a what? The discount cost. The discount cost. So how much is the interest savings? The interest savings is 49,330 minus 75,000. Minus 75,000. What is the difference here? Minus 75,000. We are getting 25,670. then 5,670, right? So on the advice, because I know now you don't know how to advise, on the advice, this is what you're going to be saying here. This is what you're supposed to be advertising. Sorry, you're advising here. Let me see whether you will be able to get it easy. On the advising, we say the proposed changes, the proposed changes in trade receivables policy, in the trade receivables policy, in the trade receivable policy would result in a net cost, will result to a net cost of 25,670. And 5,670. This is because the cost of offering, this is because the cost of offering, this is because the cost of offering the early settlement, offering the early settlement discounts exceeds the interest savings, from reducing the receivables. Therefore, the proposed changes will not be financially uh, beneficial, and the company may need to reconsider this strategy. And the company may need to reconsider this strategy. May need to reconsider those strategies. That is how the approach to the question you should be doing. But I will just be able to come across. It is a question which is tested. It is tested somewhere else. And once we are going to be doing, there is another way I will teach you how to handle the question. You can use that, or you use another one, which I can be able to show you. As we proceed. Now, I want to look on additional number 2. Additional number 2, but not the addition about the requirement. The examiner is asking you a very simple question. Using a suitable computation, determine whether the bulk purchase discount offered by the supplier is financially acceptable, right? Comment on the assumptions made in the computation. Very simple question here. This question touches the issues of the EOQ, the economic order quantity, the reorder quantity, right? That question touches there. And the people who have already gone through the same criteria when they are doing management accounting, right? They can be able to say, the first thing that you need to do when you need to talk about the issues of bulky purchase and so on, first, can you be able to calculate what? We want to calculate the EOQ. The EOQ is not take the root of 2DTO. And then you start your analysis. You ask yourself, what is our annual demand? How much is our annual demand? We say that the examiner was not able to give us the annual demand. But what he gave, in note number 3, he said that the market limited current orders, they are 15,000 units per month of product P, demand for which is constant. There is only one supply of product P. This cost of the product P purchase over the last year was 540,000, right? Now, the annual demand of ours, we have been told per month is 15,000. We multiply by 12. We know how much is our annual demand there, right? Our annual demand is our annual demand. Means 15,000 times 12. Getting 180,000, I think should be units. Right? They should be units there. You know the monthly orders, we are being given the annual cost of 500. We talk about it here. The annual cost is Kenya shillings, 540,000, which might not be applicable now. The 3 of hours, the ordering cost, how much the ordering cost is for the question? We are being told that we are being told as per the question, the ordering cost somewhere. The suppliers consider 2% discounted more. Each order cost is 150. And the holding cost of ours, we have been told is 0.2. 0.24. 0.24. So how much is our EOQ? How much is our order quantity? We say to get our order quantity, we say is 2 times 180,000 times 150 divided by 0.24. 0.24. How much it is? Very simple here. Times 2 times 150. You divide by 0.24, the root of answer, getting 15,000 units. You cannot advise, by the way. You cannot be able to advise without getting the total cost. You cannot do that. So can you be able to calculate the costs without the bulk payments? The cost without the bulk payments. Can you be able to do that? Okay. Just want to get here back to the question. We're being told there is only one supplier. The cost of product B purchases over the last year is 540. The suppliers offer 2% discount for orders of product B of 30,000 units and above. Each order. Okay. So using a suitable, determine the bulk discount offered by the supplier is financially okay. So in this case, we need to calculate our total cost here. So how do you normally get the total cost? We say, get the total cost, you normally take the holding cost. Land, we talk about the ordering cost, land the purchase. The purchase cost, right? The purchase cost comes in. Anywhere you normally find the aspects of the discount. When we have a discount, the purchase cost become irrelevant. But if you don't have a discount, this becomes irrelevant, right? Now, in this case, the formula of yours will be looking like this. HC times Q over 2 plus CO times D over Q plus P times D. I know now this is given as a lump sum amount. So the HC of ours is 0.24 times the Q of ours is the EOQ, 15,000 divided by 2. Now our CO. How much is our CO? I saw somewhere is 150. Annual demand of ours is 80,000. We divide all of these by how much is our Q. Our Q is 15,000, sorry. Then we add 540,000. So how much it is? 15,000 divided by 2 times 0.24 gives it 80 plus 150 times 180,000 divided by 15,000, getting 1,800. But then we normally say at E of Q, where if at E of Q, the holding cost and the ordering cost should be equal, and that is what I can be able to see there, plus with 540,000. So how much it is? What is the total cost now without the offer? So times 2 plus 540,000. Getting 543, 543, 600, 543, 600, 543. That is the criteria. That is how you're supposed to be handling your problems. This is how you're supposed to handle your problems. Now, let us go to the proposed. So what would be the total cost under the proposed? Right? The 2% of the discount, the suppliers offer 2% of the discount for the orders of the product P for 30. Okay. So in this case, when you are calculating for the bulk now, when you are calculating for the bulk, the total cost, this is what you're going to be doing here. The discount now will be on the purchase cost, right? The discount now, remember, you're going to be asking, what is the purchase cost? This is 540. If we buy 30,000 and above, they are going to be giving us a 2% discount. So it means you're going to be paying at 2%. You're going to be paying at 98%, sorry. You're going to be paying at 98%. So what will be the purchase? What is our new purchase cost? You just need to say 540,000 times 0.98. Getting 529, 200. This is our new purchase cost. That is our purchase cost. Now, there are other things that I know they have changed. Remember now, our economic quantity, we are not going to be using this. Because they are saying, if your order quantity will be 30 and above, we are going to be giving you this discount. So for us to get this discount, we have to purchase 30 and above. So this is how it looks like for the proposed 0.24 times 30,000 you divide by 2. 30,000 is given by the examiner. It is not this. You can't say it is that times 2. Some student may be thinking about that. Last, we talk about 150 times the annual demand is 180,000. This one is divided by 30,000, which is our order quantity. Plus now our discounted purchase cost, so 529, 200. 529, 200. So how much is the cost here? How much is the cost? So let me break it down. This is 15,000. 0.24 times 15,000. We get at 600, yeah? 150 times 180,000 divided by 30,000, getting 900. So plus 600 plus 529, 200. Getting 533, 700. It means when you are given a discount, the total cost reduces. You can see that. You just compare the total cost now and you make your decision. When you are buying at bulk, now you can be able to make your decision there. We say the bulk purchase discount offers a net benefit of somewhere there. The difference between the two, making it financially acceptable, right? Assuming that the demand is going to be constant and predictable. Then the other one, we're talking about the order and the holding costs are accurate. Then the other one will be no additional logical or storage constraints and so on and so forth. You can give a lot of points there regarding to how, because you can see the discount is viable since it is going to be reducing the overall total cost. It is another reason you can be able to provide to the examiner. You can be able to provide to the examiner. Any question, please? That is one of the questions which needed a lot of energy. That one needed a lot of energy there. But as long as you are staying with me, we have to finish this. We have to do one paper for 2 hours. Someone else to read question number 3B, please. It's coming from the Claria, or sorry if I have spelled your name wrongly. Eric, are you here? Nina, you can read.
Question number 3B. The directors
Yes.
of Bandala Limited are reviewing the options relating to a machine that is a key part of the company's production process. Option 1, replace the machine. The cost of the new machine will be 1,000 million payable immediately. Maintenance cost will be payable at the end of each year of the project. The first maintenance payment of the new machine is 51 million, although this is expected to rise by 8% per year. Option 2, overhaul the existing machine. The alternative to replacement is a complete overhaul of an existing machine, the cost of which will be 650 million, also payable immediately. This will be classified as a capital expenditure. However, under this option, the maintenance cost will be higher at 81 million in year 1 with the expected annual increase of 11%. As the new machine is likely to reduce the variable cost, the contribution will be different depending on which machine is used. The contribution from each machine, excluding maintenance cost, is tabulated as follows, with the inflow of funds assumed to be at the end of each year. Then you have contribution of new machine in thousands. Year 1 is 310,000. Year 2 is 330,000. Year 3 is 380,000. Year 4 is for 20,000. Year 5 is for 40,000. Contribution of overhauled machine in thousands. Year 1 is to 60,000. Year 2 is 300,000. Year 3 is 310,000. Year 4 is 320,000. Year 5 is 320,000. The cost of capital is 12%. Ignore taxation. Required, the NPV of each option. Option 2, the requirement 2, estimate the internal rate of return of each option. Then interpret the results that you have obtained in B1 and B2 above and recommend which alternative be chosen.
Okay. Thank you so much. This is one of the simplest questions which I can be able to see there regarding to what we have been tackling on the NPV. And you can see the examiner is asking you to determine the issues of the NPV, right? And also the internal rate of return. You remember we said the internal rate of return is the break-even of the NPV. The IRR is the break-even of the NPV. Okay. So how are we going to do this question? We're going to be looking at what will be the NPV when you are doing the replacements, and what will be the NPV when you are doing the overhaul. All right, I think I have put it very clearly, because we have been told, number one option, that the cost of the new machine is 1 billion payable immediately. Then the maintenance cost will be payable at the end of each year, right? The end of each year of the project. So the first payment for the new machine is 51 million. Although this is expected to raise by 8% per year. 8% per year. Very critical, right? Then option number 2, we are being told that the alternative of replacement is a complete overhaul of the existing machine, and the cost of which would be 650 million also payable immediately. This would be classified as capital expenditure. Okay. And we have been told, however, under this option, the annual maintenance cost will be higher at 81 million in year 1, which will be expected to increase an increase of 11% each year. If the new machine is likely to reduce the variable cost, the contribution will be different depending on when and which machine was used. So the contribution from each machine is tabulated as follows. We have been given some tabulations there. So allow me to start my question in this manner. Is how you start your question, please. So I want us to start with option number 1. The question should be 3 people. Option 1. We are talking about to replace the machine. To replace the machine. That is option number 1. Okay. So the replacement of the machine. Now, in this case, when you're looking at the replacement of the machine, you know, when you're calculating the NPV, your mind should be going back to the NPV. We normally start with the initial claim, which it is 100, or we can talk about 1 billion, right? It is 1 billion, right? Then allow me to look at the maintenance cost, or in simpler terms, because I want us to get the net contributions after the maintenance cost. Let me start with the contributions. The project is taking how many years? The project is taking 5 good years. And this is what we are told by the examiner. Allow to have some workings here. Allow, please. We have some workings for maintenance. For maintenance cost, right? So we have 5 years. Year 1, 2, 3, 4, and 5. We have our years like that. So we have been told the maintenance cost now at the first year will be 51. At the second year will be increasing by 8%. So it will be 51, 1.08. Year 3, 51. Let's 51 now. This should be 55. So let us get for that. So it will be 51. Let me show you how. So here is 51. So 51 times 1.08, getting 55.08. So 55.08, we raised 1.08. Getting 59.49. Year 4 now. 59.49, 1.08. Getting 64.25. Let us go to year 5 now. 64.25, 1.08. Getting 69.38. 69.38. Now, that is what you're being told there, right? Then the examiner has already given you the contributions. the contributions for the contribution of the new machine, that is during the replacement, will be given there. So to get the net contribution, I just want to get the net contribution. So to get the net contribution, right, to get my net contribution, I'm going to be taking the contribution provided by the examiner. We have year 1, year 2, year 3, year 4, and year 5. Let me talk about the gross contributions. And remember, all of these figures are in millions of shillings. So the first one will be 310, 330, 310. We have 330 there. We have 380, 420, and then the last one will be 440. Then we have now your maintenance cost. The maintenance cost, the first one is 51, 55.08, 59.49, 64.25. Then we have 59.3. So what is the net contribution here? Net contribution 310 minus 51, 259, 330 minus 55.08, 274, 274.92, 380 minus 59.49, 320.51. We have 420 minus 64.25, 355. Then we have 440 minus 69.38, 370. Okay, that is what we have. That is what you need to be getting there. That is what you need to be getting. Then now, remember that one you can be able to treat it in a simple way. This one, because there is no deductions which you are supposed to be calculating, you need to be able to call it as an annual net outflow. Then usiniambie mwalimu, tunatumianga 3 stages when you are computing the NPV. Where are the 3 stages? The terminal cash flow is not available in this scenario. So what am I supposed to be doing? Allow me to compute the NPV now. You're going to be saying, everybody is the number of years. Cash flows. It is. Right? How much is the discount factor? Is it 12%? The discount factor we are being given somewhere. The discount factor. The cost of capital is 12%. Getting the present value. Okay. We have here 1, 2, 3, 4, and 5, 259, 274.92, 350, 320.51, 355.75, 370.62. Let us do the discount factors. We are using this formula. That is the formula we are using. 1.12 will rest for -1, 0.89, right? The second one, 0.7972. The third one, getting 0.7118. Number 4, 0.63. 55. Then we have the last year. It was getting 0.5674, right? So 259 times 0.8929, getting to that 9, to that 1.26, 274.92, multiplied by 0.7972, you get to 19, 219.17, 320.51 times 0.7118, 228, 228.14, 355.75 times 0.6355, 226, 226.08, 370.62, multiplied by 0.5672, getting to 10.22. So how much am I getting there? Do your summation. So plus 226.08 plus 228.14 plus 219.17 plus 231.26. 1114.87. This is what is normally called the present value of the cash. The present value of the cash inflows. Then we make your initial today of 1,000. What is the NPV? We see when you are replacing, your NPV is 114. The NPV is 114. Now, remember when we were dealing with it, because I just want to do for the project one part, requirement number 1 and 2, we say when the NPV is full, you want to calculate the IRR. We normally say if the NPV is positive, it means that the cost of capital is lower than the IRR. We therefore increase the cost of capital using the trial and error. So in this case, because we just want to calculate the IRR now for this project of replacement, please, because we want to calculate the IRR now, we normally take the lower rate. We normally take the NPV of lower rates. We divide it by the differences in NPV. Then we take the higher minus the lower rates. The higher rate minus the lower rates. Very simple. Now, let us take the number of years because we are saying when you get a positive, we need to get another NPV which is negative. That is what we want. So we need to increase this. When you get this positive, we increase here. When you get this negative, we reduce. Using the trial and error experiment, so the number of years, 1, 2, 3, 4, and 5. We have our cash flows, right? The present value interest factor, I said, can we use 25%? Another one might be using 20 or 30. Then we get our present value. So the cash flow will remain the same, 259, 274.92, 320.51, 355.75, 370.62, right? When you get the discount factors, so at 25, 1.25 we raised for -1. Here we get 0.80 to 0.64. How does this look like? 3, 0.512, 4, 0.4096, 5, 0.32, 0.3277 times 370.62. Here we are getting 121.45. 355.75 times 0.4096. 145.72. 320.51 times 0.512. 164.10. 274.92 times 0.64. 175.95. 259 times 0.8. 207. 207.2. So what is the present value of the cash inflow? So my answer plus 175.95 plus 164.10 plus 145.72 plus 121.45, getting 814. Then we left with me shortly, which is 1,000. What is our NPV? 185.58. You have gotten that now. Can you use your formula now? Get the IRR. Very simple. So once you get that, you can use your IRR. You can say, to get my IRR, we are getting the lower rate. Our lower rate is 12. The NPV of the lower rate is 114. You divide by 114 minus 185.58. The higher rate is 25 minus 12. This is 8. That one is 8. So 114 plus 185.58. So 114 divided by my answer. Then you multiply it by, I think this, this is 13. Then we add 12. Getting around an IRR for 16.95%. That is how the issue of replacements are done, right? That is how you're supposed to do it. Now, we repeat the same with the overhaul now. Because we are looking for these serious marks, which are 18, that is how you're supposed to do it. What about when we are doing overhaul? Do you have any question, please? Overhaul now. You do the same. The overhaul. We do the same. So, in a short way, let me just put it in this way. To save time. Let us start with the gross contribution. The gross contribution for year one is how much? 260, 300. Is this one to be 310, 320? And here we have 320. Then less maintenance. So for the first year, we are being told it is retained at 81. The second year will be 81. Then it will be increasing by how much? 11. So this one should be 81, 1.11. 81 times 1.11. Getting 89, 89.91. That one will be 89.91, 1.11. times 1.11, getting 99.80, 99.80, 1.11, right? Times 1.11, getting 110.78, 110.78, 1.11, getting 122.90. Okay, very simple here. Let's get our annual net cash flows now. Okay, so the function will be 260 minus 81, getting 179, 300 minus 89, getting 210, 310 minus 99.80, 210.20, 320 minus 110.78, 209.22, 320 minus 122.96, 197, 197.04. From there now, allow us to calculate the NPV. So we take the years. The years is 1, 2, 3, 4, 5. We talk about the cash flows. 179, 210.09, 210.20, 209.22, 197.04. We finish at 20%. Then we get our present values. We get our present values there. Now, let me repeat 1.12, raised for negative 1, 0.8929, we go to 2, 0.7972, we go to 3, 0.7118, we go to 4, 0.6355, we go to 5, again 0.5374. Multiply with the present values, 179 times 0.8929, 159.83 to 10.09 times 0.7972, 167.48 to 10.20. Multiply by 0.7118, 149.62, 209.22. We multiply by 0.6355. We get to that as 2.96. The last one will be 197.04. Multiply by 0.5674. 1.80. The present value of the cash inflow, total in that 159.83 plus 167.48 plus 149.62 plus 152.96 plus 1.80. 721.69. We nail the initial claim. So as for the question, how much is the initial claim? How much is our initial claim? We have been told the initial claim is 650. So the NPV is how much? The NPV here, 71.69. So you do the same when you're calculating the ARR. This is positive. When you do with the 18, the same, let's take the present value at 18%. Then we get our present values. We get our present values. Okay. So at 18, how much is the discount factor? 1.18 we raised for -1, 0.8475. Even when you go to the table, that is what you'll be able to find. 0.7182, 3, 0.6086, 0.5158, then the last one is 5. 0.4371. Multiply with your cash flows, not the present values. I have just put them here because of my space. So I will multiply. The first one is 179 times 0.8475, 151.70. The second one will be 210.09 multiplied by 0.7182, 150.89. Then you go to the third one, to 10.20, you multiply it by 0.6086, 127.93, 0.5158, multiplied by 209.22, 107.92. The last one is 0.4371 times 197.04, 86.13. 86.13 plus 1 was 7.92 plus 127.93 plus 150.89 plus 151.70. 70 is getting 624. And then remember this is the present value of the cash inflow. We left our initial play, which is 650. So our NPV is how much? Minus 650, getting 25.43. So to get your IRR now, the lower limit is 12, right? The NPV of the lower rate we got 71.69. We divide it by 71.69 minus 25.43. Okay. Then we take 18 minus 12. 18 minus 12. 71.69, which is 25.43. 97, so 71.69 divided by my answer, we multiply by a difference of 6. I think this is a 6 plus 12. You're getting 16 points. 16.43%. 16.43%. 16.43%. 16.43%. So I remember there is an area they were saying, can we be able to advise? And you know that when the NPV, they had NPV and IRR, you know that when the IRR is greater than the cost of capital, it means the projects are viable, right? So the NPV and IRR calculations will be able. I've already suggested that replacing the machine is financially preferable, right? It has a higher NPV. The NPV of the other one is higher compared to this one, right? It has the higher NPV and the higher IRR. Even when you look on the IRR, the previous one is higher compared to this one, correct? So it means that replacing is better compared to the option which we have at hand, the option which we have right now, the option which we have now. Because the time imesonga sana, na sauti yangu inaendelea kupotea kabisa. So I will request you stop at that point. I think we have remained with question 4 and question 5. We can arrange, we meet on Sunday morning very early, and then we do part of that. Then next week we do another sitting as we progress in that, because on Sunday I can just be able to start another sitting. I can't start a class with you 2 questions. I will just do the 2 questions and then we start another sitting. Any question, please? Any question? Any question right now? Eric, are we satisfied?